terms and approach to how we keep track of what is in or is not in the economy. What we do track is activity levels for the economy. And this will be the lecture that then precedes the lecture that introduces some of the model of aggregate demand, aggregate supply. And that was starting the timer. So first off, what is macroeconomics and why do we call it macroeconomics? Just quickly to review, microeconomics talked about the activity of individual units in the society or in the economy. We're talking about then individuals, consumers, or individual firms interacting in the market, independent of each other, supply and demand, then establishing equilibrium for price and quantity. Macroeconomics takes a look at a much higher aggregated level, looking down at the economy from up on high, not seeing the activity of individuals interacting, but rather looking at all the people summed and aggregated together to determine total volume or total activity levels in the economy. What's the total amount of output in the economy, which we call real GDP, gross domestic product. And then all those things will then be influenced by and somewhat determine the price level, the level of the rate of change of prices in the economy over time, year to year. So the first thing is micro versus macro. What's micro versus macro? That's important to review some examples that were in the textbook and elsewhere about the sorts of things that might pertain to micro or might pertain to macro. Macro concerns principally unemployment levels, output levels, and the level of inflation. Those are the three things we care about in macroeconomics. Anything that determines those three things is going to be a macroeconomic concept or something that is going to be tested on the AP macro test. Apart from that, micro would be, well, what happens to a peach harvest, or what happens if there's bad weather, and how does that disturb a particular market? What happens if productivity changes in regard to individual firms? What happens if factor costs go up or go down? How do we determine the exact wage rate we want to pay to employees, and what's the constraint that we have that determines how much we could pay to our employees and still maintain profits? All that's micro. Macro are the bigger picture questions about how do we determine equilibrium, what happens if the government intervenes, do we have first a closed economy, how do we establish equilibrium between expenditures and factor payments, what happens when the government starts to interact with taxes and government expenditures, running a deficit perhaps, and then we open the economy. All macro things. So be careful, be able to identify specifically whether something is macro or micro. Never an essay question, but often will be a multiple choice type of question. So micro versus macro. Next thing is the circular flow. Circular flow always starts with households and firms. And households and firms interacting, so there will be flows going in opposite direction. In this picture, we have households are receiving factor payments from firms. Firms give money to households because in our model, households own all the factors of production. They have the workers, the land, the capital assets, all come from households. Households then, so these factor payments come to households, and households give money to firms for products that they receive, and then these factors of production go to firms to use to make the things that people want to receive. In equilibrium, in the simple model where we don't have any other markets except for the product market, here we have capital and product markets, so this would be a factor market down here. And up here would be the products market. And in the simple picture, the simple model, that we have equilibrium when consumption is exactly the same as the payments made to factors, or in terms of the way we do GDP accounting, the expenditures model, all the expenditures we have on goods and services are exactly equal to the income or factor payments analysis of GDP, which are the payments made to the factors. So these things would be in equilibrium. We add in other markets as we go along. First, the government market, which has a leakage. Well, actually, that would be second. First would be the private sector savings investment. If a household doesn't consume today, it's actually putting money aside to consume in the future, called savings. So there'll be a leakage out of the system here for savings, which then are available in the financial markets back to firms for investment. So what comes out as savings is injected back into the economy as investment, and that we have an equilibrium, this identity, savings equals investment. government spends more than it's taking in revenue for taxes, well then it's going to have to impinge upon the on the savings that private sector is making, and when the savings is then allocated back to government spending rather than private sector investment, then this will have to go down. So, in review, before we get to these markets, we have product and factor markets. We'll have an equilibrium when all the consumption is equal to all the factor payments. We add in the private sector savings investment, leakages for savings are equal to investments. And then we add in the government, and in equilibrium, if all taxes and government expenditures are equal, then we have equilibrium. If G is bigger than T, well then T has to, the G has to be financed by savings, and the allocation of the savings to the government expenditures means that private sector investment will decrease, which could be